Good afternoon, ladies and gentlemen. It's a pleasure to present to you today, and thank very much BMA for organizing this event. It's obviously an important initiative during these troubled times in financial markets. Let me first just introduce myself. My name is Tristan Clube. I sit on the investment committee and board for the Pakistan Opportunities Fund, managed by BMA Asset Management. I've been involved in emerging markets for around 20 years, the first 10 years in Southeast Asia and South Asia. And in the last 10 years, I've been primarily involved in the Middle East and North African region. These days, I'm independent. I have my own company called Tethys Advisors, and I have an office in Edinburgh in Scotland, and at the moment I'm talking to you from Dubai, where I spend a lot of time. About 75% of my time is spent visiting companies, primarily around the Gulf region, for one of my key clients, which is Emerging Market Management based out of Washington, D.C., which is one of the largest investors into global emerging markets. And 4 years ago, I helped them set up a dedicated fund for the Middle East region. And I guess I'm their resource on the ground here, because their approach is very much from a bottom-up standpoint. They invest into companies rather than markets. Mudassir has asked me to talk a little bit about the Middle East region. I'm going to focus on the Gulf, where I spend most of my time. Obviously, it's relevant being close to Pakistan, and in terms of FDI and portfolio flows, I think is going to become increasingly important going forward from here. Over the last couple of years, this has been very much a watershed period for the Gulf region, although we're still not part of the mainstream global indices like the MSCI index. Many of the companies in this region and markets generally are opening themselves up to foreign institutional investment. This has obviously carried a double-edged sword over recent times, because markets have become rather more correlated to global trends. In the first 8 years that I've been covering this region, most of the markets were very much uncorrelated to the rest of the world, which was a virtue at times, but at other times it sort of worked against this region in terms of attracting foreign portfolio flows. Also, in the last couple of years, the region has become more important from a political standpoint, and I think we're seeing that at the present time, given the size of sovereign wealth funds and the participation in G20, which is clearly going to be a more important political and economic forum going forward, given the state of the world economy. So in the last 3 to 4 year period, we've been very much in a bonanza period in terms of the health of the economies in the Gulf region. By virtue of the high oil and gas price, these economies have been generating huge surpluses. Over the past 4 years, we probably have accumulated surpluses of over $1 trillion, which is a very large number. And there's been an issue of absorbing liquidity into these economies, even after the enormous investments that we're seeing in infrastructure projects, in property development, investments into the industrial sector like downstream petrochemicals and energy-intensive sectors like aluminium smelters and fertilizer plants and so forth. So one of the major problems, I guess, has been absorbing these huge levels of surplus liquidity. We have a major sort of inflation problem across the region. Inflation across most of the economies has been moving above 10% over the course of this year. And as currencies in the region are linked to the US dollar, we have a negative real interest rate structure, because we have interest rates tied to what the Fed does in the States. And so with all this liquidity in the region and low absolute levels of interest rates, we've seen a boom in property markets and also excessive lending from the banking sector into these economies. At the corporate level, the environment has generally been very, very healthy. Although we've had inflation across these economies, generally companies have been able to pass through high levels of inflation through their pricing. So this year, for instance, property prices in Dubai have appreciated by around about 40%, and in Abu Dhabi as high as 60%. So for a key sector in the capital markets, the property sector, margins for developers have been very healthy. Similarly, in the banking sector, which is another key sector across these markets, this sector has benefited from the slightly tighter global liquidity environment that's been emerging over the past year, 18 months. So spreads have been generally very healthy, and the cost of capital for the banks has been low because it's linked into U.S. interest rates. So spreads have been very healthy, and we've seen strong lending growth. The other key sector is telecoms, and again, most of the companies that have been reporting in this sector have again somewhat benefited from high levels of inflation, having been able to pass through these higher costs in terms of their pricing. So generally, the corporate sector, relative to perhaps what's been going on in the rest of the world, has been very healthy during the course of this year. Valuations of the stock markets weren't particularly stretched at their peak during the third quarter. We probably had Dubai trading on around about 12 times this year's earnings, and the Saudi Arabian market at the top end of the range was trading at about 15 times. Clearly, we're in a slightly new world now, and I think it's worth addressing what's actually happened in the last 3 months. And this region has suffered like other emerging market regions. Generally, we've seen Gulf markets arguably suffer disproportionately from the flight out of emerging markets by foreign institutional investors. One of the problems here is that many foreign institutions have entered these markets through so-called access products provided by international investment banks. These products would be so-called participation notes and swaps that have been provided by these banks because of problems with regard to custody and, in certain markets, tax issues across the region. These vehicles have been created by the investment banks to buy shares on behalf of underlying foreign institutional investors. But hedge funds, mainly out of New York and London, have had access to these inventories of shares that have been bought up by the foreign institutional investment banks, and have aggressively shorted these stocks. So when trading volumes across this region were low in August and September, we saw a significant